Welcome to another episode of the Capital Playbook. My name is Charles Williams, and I am the owner and managing member of Pioneer Realty Capital, and we are so happy to have you join us today. We want to talk to you today. We're going to interview one of our team members, our new Vice President of Real Estate Development, Mr. Gary Perkins. Say hi, Gary.
Hello.
So before we get into our conversation today, which I'm 100% certain you're going to enjoy, we want to do a couple housekeeping things. If you're watching this on YouTube, be sure and subscribe and make sure you click the bell so that you know when we're going to have another episode. And then also, if you're on Spotify or if you're on Apple, please do the same. Go ahead and subscribe, and that way we can continue to bring you content like this. So as I mentioned, today we're going to talk about commercial real estate development. And now, commercial real estate is an industry that can make you very wealthy, but it has also made people very poor. So knowing what to do and how to do it is really, really important. And so that's why we wanted to take some time to interview our resident expert, Mr. Gary Perkins, and talk about the process of developing commercial real estate. Now, Gary, tell us a little bit about your background, your history. How did you get into commercial real estate development?
You know, actually, my background is construction. I got into real estate development when I went to work for Charles Holbrook. He was a former Trammell Crow partner, had the whole southern part of the United States. Very, very sharp guy, and I learned a lot from him.
Okay. Yeah. And what type of projects were you developing when you first got into commercial real estate development?
Garden style apartments, primarily.
Yeah. So a lot of your background and experience has been developing apartments, and I know you've done some student housing.
Yes.
Have you done other asset classes as well?
Condominiums, some commercial buildings, but primarily multifamily student housing.
Okay, well, very good. So, let's talk about the development process. So, could you walk us through the steps of developing commercial real estate? In other words, most people, that are thinking about getting into this, they probably want to know, what is step one? Where do you start when developing commercial real estate?
Well, step one is you need experience.
Okay.
You have to have a strong balance sheet, money to invest. Lenders only loan money to people that don't need money,
right?
So to speak. You know how that goes. And then you have to investigate and really do your research, on the prospective project, where the land is, what the feasibility analysis is, basically try to prove why it won't work first. And then when it surpasses that criteria, then you dig in deeper and follow the protocol all the way through.
Well, very good. I really appreciate the fact that you mentioned that you have to have a decent balance sheet.
Yes.
Sometimes people think they can go and develop a 200-unit apartment building, and they have very little history in the business. They have no money, to speak of, but they imagine some lender is going to give them millions of dollars to go do something for the very first time. And what you're telling me is it doesn't work that way.
It does not work that way at all. At all.
Yeah.
It's a recipe for disaster. And lenders are sharp. They're not going to, take on unnecessary risk. You have to have money and experience.
Right.
Period.
Makes a lot of sense to me. I know if I was going to give my money to someone who's going to build apartments for me, I'd like for them to have a couple days experience, right?
At least 2 or 3, kind of round it up.
Right. Okay, so the first step, making sure that you're a qualified sponsor is what
Correct.
we call that. Financially qualified in terms of experience, know the business, right?
Absolutely.
And that's one of the important things we do here with our Capital Playbook is we really spend a lot of time trying to make sure that people that view our podcast know the playbook, know the game. They at least understand a little bit of it, right?
Right.
So now once we've qualified as a sponsor, or maybe we partnered with a qualified sponsor. So Gary, you mentioned site selection being one of the first steps. What actually goes into site selection?
Well, actually, a lot. I mean, you want to target a market that's hot and growing.
Mm-hmm.
In a population of typically 500,000 people or more.
Right.
And so you want to be successful.
Okay. Yeah. So, and that's important because when you're building something, the purpose of building it is to ultimately sell it, right?
Correct, or keep it for cash flow.
Okay.
Yes.
So there's a cash element involved with the development of this asset.
Yes.
Right. And so what drives ultimately that eventual cash flow or drives the sale is a demand for the product.
Correct.
Yeah. And
Correct.
so there are certain studies that help us to appreciate that demand for that product. What are some of those studies that we might engage when we're doing that site selection to determine if there is demand for that product?
A third-party feasibility analysis is the best way to get it done.
Mm-hmm.
They typically have all the statistical information and can give you a thumbs up or thumb down pretty quick for a nominal amount of money, $5,000 or so,
Mm-hmm.
with a reputable company. And that's money well spent before you start spending money on plans and specs and digging in deeper, because that gets to be, you can run up $1 million pretty quick. Once you start moving forward.
Oh yeah, I know.
You've experienced that.
I've experienced that. So the site selection, the feasibility study, going to measure demand in the market for your product. It's going to really help you kind of structure your deal. At what point do you take control of the property that you're evaluating? Do you go and buy the property first, or do you put it under contract? What's the best approach for getting control over the property before you start spending that feasibility money?
Sure. Generally, you want to get the property under contract, with options for your feasibility analysis. At least 90, 120 days look, and that way you can figure out if you're going to go or no go. So,
right. Well, and that makes sense because, if the property is $1 million, it wouldn't make sense to go and even though I've done it before.
Yeah, we need to talk about that.
In general, it does not make sense to go and buy that property before it can be zoned.
Correct.
For the asset you're looking to construct.
Right.
Or if it's even feasible.
Correct.
Because you can sink $1 million into a piece of property and find out there are all kinds of easements.
Right.
Across that property, and you can't build anything.
Correct.
And then that
floodplain, all kinds of issues.
Could be a floodplain,
yes.
Or could even be a graveyard in the middle of it.
Right.
Right.
Or if you're in Austin, it could be all kinds of insects in a cave or something that's a hole about 3 foot by 3 foot.
Wow.
I've experienced that firsthand.
Wow, that sounds like experience. Yeah. So there are certain studies and due diligence that's required before actually doing what we call taking down the land.
Correct.
Right.
Correct.
And that's the actual purchase of the land. So let's say that we purchased this land, we've done our feasibility study, and it looks like this area would support this 200 unit apartment complex. It's in a good area. There's demand for it. We're ready to go ahead and close on our land now, right?
Right.
Once we close on the land, what's the next step?
The next step, of course, is getting your pro forma put together, which you should already have that done before you close. And then you start looking for financing, both debt and equity and or mezz, to put your financing package together.
Now, you mentioned that the importance of having that pro forma. Where does the data come from to put in that pro forma? In other words, how are you validating those pro forma numbers?
Typically by your feasibility analysis,
right.
what the comps are in the area, what their rent rates are, what your construction costs are is a big factor of that. What is your cost of money? Right. Your interest rate, et cetera, so that you can be competitive in the market.
Okay, very good. So that feasibility study and those the market research, we didn't mention the topographical studies.
Oh, yes.
And some of the environmental studies. We refer to those in the industry as third-party reports.
Correct.
And those reports and understanding not only what reports are required to put a deal together, but understanding how to read and interpret the report.
Correct.
It would also be very important.
Correct. Like your phase one environmental study, your geotechnical study, all those are paramount from a risk factor. you want to flush out if there's some serious problems with the property before you close on it, for sure.
Yeah, absolutely. And now many of you who are watching our show may not ever go out and develop anything, but perhaps you might want to invest with a developer or invest with a group who's looking to go and build, develop a piece of property. And these are questions you would want to be asking that developer. You would want to be asking them about the third-party reports and understand the importance of those reports.
Correct.
And if you ask your developer or the group that you're investing with these questions and they don't know what you're talking about, probably a good sign that
yeah, you don't want to invest
you
in
might
that.
not want to invest with them.
Right.
Right. Okay, so now we've gotten past the third-party reports and we put our budget together. What's our next step?
Well, you have preliminary drawings, which I call a mortgage set to get your financing.
Okay.
And you do preliminary pricing from general contractors from that set, so you know where your budget is, give or take. Then you start dialing in your unit mix, et cetera, your architectural layout on your site plan, what density you can get. The higher density, the more profit you can make,
Right.
Et cetera, as long as the market demand will tolerate it.
Mm-hmm.
And so you start moving forward with that, your civil, all your mechanical, MEP, engineering drawings, et cetera.
Okay, good. So now we talked a little bit about those drawings, the MEP, mechanical, electrical, plumbing, civil engineering. That's going to do our horizontal design and design our sewer, and architect that's going to design the building. What goes into the selection of your design team? How important is that?
It's paramount because that's the basis of your project. Is it aesthetically pleasing? Does it maximize density? All those things come into play, and it's important to find people with experience.
Right.
You don't want to go with an architectural engineering firm that's never done it before but always wanted to.
Right.
You don't want to be the guinea pig.
Right.
And that's real important. And I have relationships with people for years and years and years. And people do business with people. So
right. And that can't be understated because, and you have heard me say on the show before, this part of the process is what I call the 2D portion. It's two-dimensional, it's on a piece of paper. Right. But at the end of the day, somebody's got to turn it into 3D.
Correct.
Somebody's got to build it, right? Correct. And there are some phenomenal architects, engineers out there that can put together what we call a really good set of CDs, construction drawings,
right,
that are buildable.
Right.
Have you ever seen a set of construction drawings put out there that nobody can build that?
Well, that's kind of a loaded question.
Right.
I mean,
nobody should build
exactly.
it. Exactly. Right?
Yes, I've seen that before.
Right.
Yes.
So understanding your design team and their capability, that could crash your project.
Yes.
Everything else could be right on line, and you hire the wrong design team. And, I'll ask you this question, just so that our audience can appreciate what can happen. Let's suppose that you get an architect, engineers, they put out a set of construction drawings, but they're really not buildable. But the contractor has priced the job.
Correct.
And has been awarded the job.
Right.
Based on these construction drawings. What is the economic consequence to the developer if those are some really tough drawings?
Money.
Yeah.
Financially. I mean, it gets very expensive when you start deviating from plans and specs and the unknown. And I think the key to that is have a good general contractor that you work with, that and you have a good relationship with, as well as the design team, and they work in concert with each other.
Right.
So you end up with a project you can afford to build and use the expertise of the general contractor on what works and what doesn't financially.
Right.
Because they have the experience. And then the architectural firm, you want the design, amenities, and all the aesthetics to look very attractive and pleasing. So you build a good, solid product that you can make money on.
Absolutely. And if you don't have that, and that general contractor and his subs have bid that job, but the construction drawings are poorly put together, you get what are called change orders.
Yes.
Right?
Yes.
And now when a contractor submits a change order, are they giving you bargain basement pricing generally?
Absolutely not. Absolutely not.
Right. Anytime you have to change something,
Yeah.
and they know there's no bid process for change orders, right?
Correct. Correct.
So they have no competition, and they pretty much have the developer over a barrel.
Well, they can have, depending on the contract documents and what their markup fees and stuff are.
Well, that's a very good point, and we really should talk about the types of contract because that makes it. You make a good point. Tell me how a well-structured contract can protect you against excessive change orders.
Sure. Well, a contract is just that. I mean, you're talking about the contracting business. You have a general contractor who is like the general of the army, so to speak, and then you have subcontractors that contract with him. And so you want a good attorney who is a construction attorney who knows what he's doing to draft a contract that's fair to both parties.
Right.
You know, fair to the general contractor and fair to the developer, and you want to mitigate as many risks as you possibly can. And for his sake too, because if you have a poor set of plans and they have to come up with a lot of requests for information, construction change directives, et cetera, it costs that contractor more money too. And so you want to mitigate that as much as you can. And that's why I think it's very important to bring the general contractor on early on and work in that relationship together as a team. Okay,
very good. Great advice. You see your years of experience. It seems like you've learned some things over the years.
Oh,
right?
I've had a lot of knots on my head over the years. You know, learning curve is not for the faint of heart in this business, for sure.
Yeah. So now you've hired your design team. They've given you a great set of construction drawings. You've hired the general contractor and his subs. What goes into the qualification process or your evaluation of the GC and potentially the subs that GC hires?
I mean, generally you qualify the general contractor and he qualifies the subs. Okay. You know, et cetera. And so you get an AIA document, qualification statement from him, which shows past work, what his backlog is currently, what jobs he has going on. Right. Because he can be a great contractor and he has 10 jobs with actually, you know, he can't handle but 8. And so he can be great, but once he gets real busy and gets spread thin, then the risk goes up quite a bit. So you want to make sure you understand that. You want to understand financially how strong he is, what his bonding capacity is, not necessarily to bond the project, but know what he can handle and move forward, and what his team is for your specific project. Okay. That means a lot. Okay, very good. So now that you have your contractor identified, hired, they're on the job, they're building, what's the role of the developer from the time that now you've started construction, moving toward the completion of construction? Well, I'm a big believer in that you get what you inspect, not what you expect. Good point. So you need to be out there at least once a week on site, seeing what's going on, having one of your people out there as an owner's rep, you know, understanding where we are, what the challenges are. And there's always challenges. I don't care how good the documents are, how good the architects, engineers, general contractor, there's going to be some things pop up. And so you have an obligation to that contractor to respond timely to keep him moving, because time is money. Right. It cost him money and it cost us money in interest carry. Yeah. So you want to work together and keep marching forward. Okay, well, very good. So now we've gone through the project. Now, I didn't really touch on this a lot, but it's really important to discuss. What role does the city and the relationship between the developer and the city play in the success of a project? Well, it's really important because they have a vested interest in the tax base for this product that you're producing. Right. And they can hurt you. I mean, most cities are fair. Most cities take a long time to get your building permit processed, et cetera, which is difficult sometimes. But once you get going, you want to make sure the inspections are done timely. You want to reciprocate with the city and kind of keep an open book. You don't want to cover up an inspection that you never called in and try to move forward. Just simple things like that. And people do business with people, not companies, not cities. It's all about the relationship with the building inspector and try to look at things from his perspective so you can help him make his job go easier, and he generally will reciprocate with you as you move forward.
Yeah, it's a relationship business.
It is, absolutely.
Yeah. And so it's an important, and again, if you're investing with a developer, you want to make sure they have experience and they have those relationships or know how to properly manage a relationship. There are people who sometimes mismanage relationships, and you want to be able to pick up on that fairly quickly.
Correct.
So that does not become an issue.
Yes.
Yeah. So now that you have hired or you have this relationship with the city, your project's going well, project's built, right? What's the critical how do you transition from construction to a project that's actually paying rent?
Well, the transition's important. You bring a property management company on well before it's finished. You let them punch the work too, because they're going to have to own it, so to speak.
Right.
Once it's turned loose from construction, they take over and manage it. You want to start the leasing process as soon as practical and lease the buildings up as quick as you can. Getting COs for certain buildings, you can start turning those because time is money. And if you look at your pro forma and you do some sensitivity analysis, you'll see what I'm talking about.
Oh, yeah.
If it takes longer to get that CO, those rents aren't coming in, and your interest payments are still going, your taxes are still due, insurance, et cetera.
Right, yeah. So every year you got pretty huge tax bill. The more complete you get, the bigger the tax bill gets.
That's correct.
Imagine that,
yes.
right?
Yes.
And that interest carry I've seen interest carry kill developers.
Oh, yes, it can.
Yeah, put them out of business.
Yeah, if you go too long, it's not a business for the faint of heart by any stretch.
And it's interesting that people oftentimes look at the successful project, but underestimate or undervalue the level of expertise that goes into making a project successful. And again, if you're looking to invest in commercial real estate and you're investing with a group and they don't have that experience, understand all the steps that are required to make that investment work and get your return on that dollar. It's easy to put it on paper, but it takes a little effort to make it reality. Would you agree?
It takes a lot of effort.
Yeah.
And a lot of good people. You have to have a good team. You're only as good as your weakest link. One link breaks, and it costs you money.
Absolutely. So now we started out talking about the financial wherewithal of the developer. And just to reiterate that, again, how important is that? And why is it so important?
Well, it's important in every facet because you're responsible for that project. Oftentimes now, the way the market is, financing market is, you have to sign personal guarantees.
Right.
So you're basically risking everything you have on the success of that project.
Yeah, that's exactly true. And if you have a developer who has the ability to do that and willingness to do that, that's important because they have that skin in the game right alongside you as an investor. So that's very important.
Yes.
Well, this has been a great conversation, and I'm certain that our audience and those who invest with us are going to be very, very interested in this particular podcast because it actually shows how we add value to our clients and certainly gives you things to look for when you're looking to invest in a commercial real estate development project. Mr. Gary Perkins, VP of Commercial Real Estate Development for Pioneer Realty Capital, thank you so much for being with us. And so definitely want to have you back and talk about some of our other projects we're doing as we progress in those projects, okay?
Excellent.
All right.
Enjoyed it.
Thank you, Gary.
Thank you, Charles.